Schwab is moving into Bitcoin and Fidelity's already there. And Tesla, well, they hold over $1 billion of it on their balance sheet. But here's what most retirees don't realize. Even if you've never touched crypto, you're probably already exposed, and that can either work for you or it could blow up your retirement plan. I'm a certified financial planner who's helped people retire confidently for over a decade. And I'm not here to hype Bitcoin. I'm here to give you a smart framework to protect what you've built, avoid the noise, and make sure you're not caught off guard as crypto moves into the mainstream. So let's start with what's actually happened right now, because this isn't just an internet trend anymore.
It's something where people who are of less than stellar character see an opportunity to clip people who are trying to get rich because their neighbor's getting rich buying this stuff that neither one of them understands. It will come to a bad ending.
Schwab, one of the most conservative and retirement-focused institutions in the country, is preparing to roll out spot Bitcoin trading. Fidelity already offers it, and BlackRock, one of the largest asset managers in the world, launched its own Bitcoin ETF and is already seeing billions of inflows. And these aren't fringe platforms. These are the companies managing trillions of dollars, many of which are directly tied to your portfolio, your 401k, or your retirement account. And they're not doing it because they believe in memes or the tech hype. They're doing it because people like you, prudent, serious investors, are asking questions about Bitcoin. They see the demand, but they also see the dollar signs. So no, this doesn't mean you need to go out and buy Bitcoin today, but it does mean you need a response plan. Because whether you invest in it directly or not, this asset class is making its way into the mainstream financial system. So if Bitcoin is going mainstream, are you sure you're ready for how it'll show up in your retirement plan? Because what if I told you that even if you've never bought a single Bitcoin, you might already own some? I know, sounds crazy, right? But here's the thing. Tesla, one of the largest companies in the S&P 500, holds over 11,000 Bitcoins on its balance sheet. That's more than 1.2 billion in Bitcoin as of this year. And guess what? Tesla is a top 10 holding in most S&P 500 index funds, total market ETFs, and retirement target date funds. And so if you're a diversified investor, you likely are already exposed to Bitcoin just indirectly. And Tesla's not the only one touching crypto. Google's parent company, Alphabet, has invested over $1 billion in blockchain startups. Microsoft is backing Web3 companies through its venture arm. NVIDIA's chips power much of the crypto infrastructure, and they've even explored adding Bitcoin to their balance sheet. And you might be surprised and maybe a little unsettled to find Bitcoin quietly sitting in your portfolio already. So the real question isn't, should I buy Bitcoin? It's, how much exposure do I already have, and am I okay with that level of risk in my retirement plan? Because this is the part no one talks about. Because the conversation around Bitcoin is usually all or nothing, but real investing is rarely that extreme. You don't need to believe Bitcoin is going to $1 million. You just need to be aware of where it already exists in your portfolio and make sure it's not quietly increasing your risk, or worse, catching you completely off guard. Okay, now here's where it all starts to come together. Up until this point, we've talked about how Bitcoin is going mainstream and how it may already be showing up in your portfolio. But now it's time to answer the real question. What should you actually do about it? And the answer depends on what you believe about Bitcoin and how much exposure you're comfortable with. So let's start with allocation, because this is where things can go sideways fast. See, some people will tell you 1% is pointless, while others will say 100% is the only way to make it count. But the reality is, it's not about what anyone else thinks. It's about having a strategy that matches your retirement goals and your risk tolerance. In our practice, when clients ask about individual stocks, in most cases, we usually recommend limiting the position to around 5% of the total portfolio, sometimes less. That same logic applies here. Bitcoin is still a highly volatile, concentrated position. So if you're retired or approaching retirement, we typically treat it like a satellite position. Separate it from your core retirement plan. And sometimes that even means keeping it in a completely separate account, not factored into your retirement income projections. That way, if Bitcoin does go to zero, your plan still works. And if it takes off, well, that's great. You get the upside. So whether you're thinking about 1% or 3 or 5%, the point isn't chasing the right number. It's having a framework that keeps you grounded and keeps your plan intact no matter what Bitcoin does. But let's break that framework down further. If you believe Bitcoin is a new form of money, it's decentralized, censorship resistant, and potentially a store of value, you're closer to what its creator envisioned in the original white paper. And in that case, you might lean toward owning Bitcoin directly using cold storage or a private wallet. But that comes with full control and also full responsibility, securing your keys, tracking taxes, and handling estate planning. On the other hand, if you just want exposure to the price movement or diversification, but you don't want to deal with the tech side, then a Bitcoin ETF could make more sense. ETFs are easy to buy, hold, track, and you can place them in taxable accounts or retirement accounts depending on your situation. But let's talk about estate planning, because this is the area I think most people completely miss. You see, if you own Bitcoin directly, especially in cold storage, your heirs will need access to the private keys, passwords, or seed phrases, or that wealth could vanish. That means documenting it clearly, titling it properly, and including it in your estate plan with specific language. With ETFs, this is much simpler. They behave like any other stock or fund, and you can assign beneficiaries or include them in a trust like any other asset. Okay, so what's the bottom line? You don't need to believe Bitcoin is going to replace the dollar or hit $1 million a coin. But if you're thinking about exposure at all, this framework helps you do it on purpose, not out of hype or fear. And that's how confident retirees engage with a fast-changing world without falling for extremes. At the end of the day, Bitcoin isn't just a speculative gamble or a fad, it's a new layer of the financial system. But again, here's the key. You don't need to believe Bitcoin is going to $1 million to have a plan for how it fits into your life. You need a framework, and as discussed, that framework helps you decide how to invest, either direct or an ETF, know where to invest, either in a taxable account or retirement account, and how much to invest, maybe somewhere between 1% and 5%, or maybe just through equity exposure. And most importantly, know how it affects your retirement plan. This is what we help people do every day. As a certified financial planner who's helped people retire confidently for over a decade, my job isn't to predict the price of Bitcoin, it's to help you build a plan that works whether it goes to the moon or to zero. And that's why having a thoughtful allocation separate from your core retirement plan is so important. It gives you the freedom to participate without the fear of jeopardizing your future. Now, if you're curious how to take this even further and you're wondering how someone could actually create a retirement income plan that lets them keep $100,000 completely tax-free, I break it all down with real numbers in this next video. This is one of my most popular videos because it shows exactly how retirees right now are legally keeping $100,000 of income completely tax-free. Click right here to watch how one of our clients pulled it off without any fancy Roth conversions. It'll open your eyes to what's possible. This is Alex Okagawa, financial advisor and partner here at 1 Degree Advisors. If you want to get in touch, our contact information is in the description below. Thanks for watching, and I'll see you in the next video.